Hey traders, and welcome to another video of Hall of Traders. Today we're diving deep into a critical skill every trader needs, the ability to identify high-quality and valid liquidity zones and imbalance zones. In the market, this skill is not just a step, it's the first and key one you should master to pave your way to becoming a profitable and successful trader, because without mastering this topic, you are likely to fall into market traps. In this advanced episode, we dive into various types of liquidity and trading strategies and associated price actions that you might encounter in the market. But that's not all. We'll also break down the key criteria and rules that can turn an imbalance zone into a high-probability trade. So traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. See you after the intro. Welcome back, traders. So let's get started. Starting with liquidity. What is liquidity? Liquidity is simply money in the market, and this money is the stop loss of the retail traders. Every time you lose a trade, you adding liquidity into the market. There are two types of liquidity, and these are buy-side liquidity and sell-side liquidity. Buy-side liquidity represents a level on the chart where short sellers will have their stops positioned, while sell-side liquidity is just the opposite. It represents a level on the chart where long-biased traders will place their stops. In both cases, these levels are often found at or near extremes as the tops and bottoms of ranges, and are often viewed as areas where traders are proven wrong and therefore will want to get out of their trades. We have now understood the types of liquidity. So where can we find liquidity? Because without knowing areas with liquidity may force you take bad trades and end up get taken out of the market. So, liquidity can be in form of equal highs or equal lows. In price action, there are chart patterns. One of the most known ones are the double top and the double bottom. Smart money concepts refers to these double tops or bottoms as equal highs and equal lows. Secondly, liquidity can be found resting below or above trend lines. A trend line is a line drawn over pivot highs or under pivot lows to show the prevailing direction of price. Trend lines are a visual representation of support and resistance in any time frame. Retail traders are taught to buy at a trend line or wait for the breakout of that trend line to go short and vice versa. With this, it creates a lot of liquidity at these areas that the markets will manipulate to grab liquidity before a larger move in the markets can take place. Thirdly, liquidity can also be found below major support and above major resistance. Support is a price level at which the price bounces after a downtrend. Generally, this is an area where demand forms and market participants place their buying liquidity. Resistance is a price level at which the price is rejected after an uptrend. Next, liquidity can also be found below swing lows and above swing highs. We can also find liquidity resting below demand zones or even above supply zones. In a limit order market, all traders with access to the trading system can supply liquidity by submitting limit orders or demand liquidity by submitting market orders. Take an example here on the chart. We have a demand zone. Many retail traders look at this zone for perfect trading opportunities. So they will place market orders around this zone and set their stop losses below. The market orders and stop losses here makes this demand zone a zone with high liquidity. The same applies to supply zones. So guys, we have understood liquidity, forms of liquidity, and also we have known areas where liquidity rests. Now let's understand imbalance zones, because the trading strategy I'm going to show you only requires both liquidity and imbalance zones, so make sure to watch till the end. And if you are enjoying this video, make sure to give it a thumbs up to show your support, and don't forget to subscribe if you're new. Now, how can we define imbalance? Imbalance is a market situation where the supply of buyers is significantly higher or lower than the demand of sellers. This can cause the price of an instrument to move quickly towards higher supply or lower demand. Note, imbalance is the same as fair value gap, and these are the factors to be taken when marking a valid imbalance zone. 1. There must be at least 3 consecutive large candles of the same color. Secondly, there must be space between the wicks of the neighboring candles. Lastly, this sharp move should happen after consolidation. Here is a quick example of a bearish imbalance. In this case, we are seeing 4 consecutive large bearish candles, and there is space in between wicks of each neighboring candle. Now we mark the imbalance starting from the last candle that caused this sharp move. Here is another example with a bullish imbalance. Following the rules, Here are at least 3 consecutive large bullish candles, and there is space in between the body and wick of each neighboring candle. We also notice that the entire move originated from this area of consolidation. Now all the rules are valid, and we can now mark our imbalance zone. So guys, let me show you how you can use liquidity and imbalance trading strategy. This trading strategy relies on the assumptions. 1. Price has to return to fill these imbalance zones. Secondly, price has to grab liquidity while filling the imbalance zone, meaning there should be liquidity. Lastly, price has to change after grabbing liquidity and filling the imbalance zone. We can wait for a change of character in a lower time frame. Let's see real chart examples. Here on USD/JPY 1-hour chart, the price is in an uptrend, making higher highs and higher lows, breaking structure to the upside. We also notice that the price made a sharp move after consolidation around this zone, leaving behind imbalance that needs to be filled. We also notice that after breaking the structure to the upside, the price is now making a retracement targeting the unfilled imbalance zones. So let's wait and see if creates liquidity due to some early retailers who would want to buy within this imbalance. Price continues retracing to the downside and it fills the second imbalance. We now have to wait for price to grab liquidity, and after we take our trades, price grabs liquidity and we are now free to enter the trade, placing our stop loss below this area and take profits above the next supply zone. Now we have it. Price continues higher and reaches our target. Let's see one more example. On Swiss franc Japanese yen 15 minutes, the price is in a downtrend. If we observe, price has made a sharp move to the downside, leaving behind imbalance that needs to be filled. Now let's wait and see if price will come back to fill these imbalance. Price continues downward, it creates liquidity and comes back to grab it. Price gets it to this imbalance after grabbing the liquidity and after closes out of it. We can now enter this trade with a risk to reward ratio of 1 to 2. So let's see how this trade goes. Price continues lower and reaches our target. So guys, thanks for watching, and if this video was helpful, don't forget to smash the like button and subscribe if you're new. See you in the next video.